Joey, we are getting our first look at the jobs report this morning. U.S. employers pulled back on hiring this month. The Labor Department announcing this morning that employers added just 75,000 jobs, the fewest since February. Joining me now from Rockland Trust is Matt Roddy to go over these numbers. So what does this mean?
Well, I think these numbers obviously came in weak. They actually revised the prior 2 months' numbers down as well. The Fed's been in a little bit of a pickle right now because they're really having a hard time, raising rates, if you will, with low inflation, but they're having a hard time lowering rates with really strong unemployment. And so with the weakening employment picture, it might get them out of the pickle. It might let them maybe swipe a base, take a rate cut, try and maybe offset some future tariffs, some of this weakness that they've seen in inflation, and now some of this, starting to see some weakness in the hiring, which is, it's a good thing. I don't think it's good to be indecisive for too long if you're a Fed. Just like in a pickle, you don't want to be standing still. I think you got to make a decision to go one way or the other. And I think if this lets them go with a rate cut in the next couple of months, I think that could be a good thing.
Does this point to a trend? Are we looking at a trend downward? Is the economy softening, as we're hearing some of the experts say?
Yeah, I think it does. There's been indications before this, but this really says that the companies are maybe just being a little reluctant to hire with some of the uncertainty that they're seeing out there. They're getting good productivity from the workers they have, so they don't maybe need quite as much. That's not a bad thing, but it does sort of weaken some things. And it is a trend. We've had 2 clunkers out of the last 4 months when it comes to these employment numbers. The ones in between were strong, but we just revised those numbers down. So it's a lower number this year considerably than last year's numbers.
So you kind of look at 3 months, you were telling me, as a trend,
Yes.
or at least 3 months.
Yes. Yeah, in the last 3 months, the numbers have come down. From 2018, we were well over 200,000 on average. This year, we're well below 200,000. You really want the number to be solidly, consistently above 100, maybe even towards the 150 number to kind of say we can keep kind of going along. 2 numbers that in the last 4 have been well below 100, so that's not a good, consistent thing.
Just going back to the interest rate question, if they do lower interest rates again, I mean, that will obviously help in lending and in mortgages and things like that down the road, correct?
Correct. Actually, that's already probably taken place a lot because the long end of the bond market's come way down. In fact, last year we had a big move down in yields in the longer end, which affects mortgages and a lot of the commercial lending that's done, business lending that's done. So you could say the market was predicting this, but the shorter end will really start to stimulate even more so, and will steepen the yield curve and kind of bring back some animal spirits, hopefully. That's sort of the intent.
All right, Matt Roddy, Rockland Trust, thank you. Have a nice weekend.
Thank you, you too.
Appreciate it.